2,500 open interest rolled forward from March 26 to May 26 silver futures contract. That's on COMEX. Well, that means that people who are long March silver, they've rolled into May. They sold the March and bought the May. So that means they're not going to stand for delivery.
And it's on coins. So the margin is the highest margin I've ever paid on a gold coin. Normally I'm paying around 150, 125 bucks over. I'm actually since Swiss francs, but Swiss francs are worth a bit more than $1. This time I think it's getting on for 350 or 400 bucks over. It does, the metals have been, we've had days where they've been up 5, 6, 9, even 10% sometimes, and then down as much. So if you're a dealer, what are you going to do? You don't take in stock because the price might plunge, and you don't sell stock because the price might soar. So what you do, either you close your doors or you widen your margins. I think, first of all, the fundamentals behind both gold and silver have not changed one iota. Mm-hmm. We're still living in a world of geopolitical uncertainty.
Despite recent roller coaster volatility where silver saw a dramatic 10% single-day crash, the long-term floor remains solid as central banks in China and Turkey continue to aggressively pivot away from the dollar. With the gold to silver ratio recently hitting a 15-year low, a massive physical squeeze is brewing. Some analysts warn that exchanges could face a default as early as next month if delivery demands aren't met. Joining us to break down this chaos is Clive Thompson, a veteran precious metals expert and retired Swiss banker. In this session, Clive explains why dealers are widening margins to record highs, sometimes $400 over spot, just to survive the wild 10% daily price swings. He argues that while the paper price is erratic, the fundamentals are unchanged due to geopolitical uncertainty and central banks treating gold as an essential parachute against debt. But with global silver inventory reportedly vanishing from vaults, are we witnessing the end of the paper market as we know it? Watch to find out. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Well, dealers they just don't know where the price is going to be tomorrow. So they've expanded their margins very significantly in both directions, whether you're a buyer or seller, because, you might buy the metal at a certain premium, which is a very high premium, but the price of the underlying could move that much in a day. Recently we've been seeing moves likes of which we haven't seen in years. Daily moves well in excess of 5%. I think silver today is, if I'm not mistaken, I looked earlier, it was up or was down 6%. I'm looking at the screen now.
It dropped pretty hard today.
Yeah, I mean, so the metals have been. We've had days where they've been up 5, 6, 9, even 10% sometimes, and then down as much. So if you're a dealer, what are you going to do? You don't take in stock because the price might plunge, and you don't sell stock because the price might soar. So what do? Either you close your doors or you widen your margins. I think that's what's going on. All the dealers have widened the margins. In fact, I've just agreed to buy some gold myself today. I haven't paid for it. I'm paying for it tomorrow, but we fixed the price, and it's on coins. And the margin is the highest margin I've ever paid on a gold coin. Normally I'm paying around 150, 125 bucks over. I'm actually since Swiss francs, but Swiss francs are worth a bit more than $1. This time I think it's getting on for 350 or 400 bucks over. It doesn't matter what you're dealing in. Right now it's gold and silver for everybody, but deal in small quantities, which gives you a second chance if the price goes against you to get that second slice or third slice. You go in more than once at the price, which might be better or worse, but it doesn't really matter which way it is. You're never going to be the last fool because you won't have paid the highest price if you're buying. Well, first of all, the fundamentals behind both gold and silver have not changed one iota. Mm-hmm. We're still living in a world of geopolitical uncertainty, a world in which central banks are wanting to increase their gold holding. I think the latest announcement was from Holland, who said they're going to buy some gold. Nations are starting to say we can't rely on having all our reserves in dollars, and they're diversifying, and gold is the obvious way to diversify because it's nobody's liability. But I think it's not. Obviously, there's also the worry that the debt problems of the world are not being addressed. Right. Governments around the world continue to engage in deficit financing. They spend more than they're taking in. Europe is now going to be a bit of a problem because of the defense side. Europe has got to spend a lot more money on defense as part of the NATO agreement. So that means the defense budget across Europe is going to be going up for governments which are already heavily into deficit. And what that means is that the debt will be increasing at a faster rate than GDP. And so why are people buying gold? So historically, people would buy gold and say, well, it's not really if they had any at all, it's just sort of like my little keep pace with inflation asset. But I don't think people are looking at inflation anymore. I think they're starting to say, it's not a question of inflation, it's a question of insurance.
Clive's fundamental case destroys volatility means thesis broken narrative. 1. Not changed one iota. The reasons to own gold, silver, geopolitical chaos, central bank buying, debt spiral are identical to what drove January surge. The correction doesn't invalidate fundamentals. 2. Central bank buying accelerating, not slowing. Holland latest to announce purchases. This is paradigm shift. Central banks accumulated 1,000 plus tons in 2024, continuing 2025-2026. When world central bankers, who have inside info on currency debt problems, are buying, retail should listen. 3. Can't rely on reserves in dollars is de-dollarization theme. Not just Russia, China, but now European allies, Holland, publicly stating they need alternatives. This undermines dollar's reserve status, supports gold. 4. Debt crisis worsening, not improving. Governments spend more than taking in. Deficit financing continues globally. No political will to cut spending, only to pile on more. Europe defense spending must rise, per NATO's hundreds of billions additional expenditure by countries already 80 to 120% debt GDP. 5. Debt increasing faster than GDP, debt-GDP ratio spiraling. This is unsustainable. Eventually leads to monetization. Print money, inflate away debt equals gold, silver up. Default. Currency collapse, gold, silver up. C. Austerity, social unrest, geopolitical uncertainty, gold, silver up. All paths lead to metals higher. 6. The inflation versus insurance shift is profound. Traditionally, gold seen as inflation hedge, keep pace. Now it's seen as parachute, insurance against systemic failure. This mentality change means gold holders won't sell easily. It's insurance. You don't sell until need it. Buyers less price sensitive. Insurance value isn't about price, it's about having it when crisis hits. 7. For COMEX disaster, fundamental support continued physical demand. Central banks, insurance buyers, colliding with limited supply, 98M registered equals squeeze intensifies.
Or parachute. If things go badly wrong with the debt or with the currency, I want to have something which, one, I don't need to ask anybody permission to own it. I don't have to go down to the bank and say, please, would you give me my money back? I don't have to go to the government and say, can you give me something? I've got something which is my own and I don't have to ask permission. So if we do get into a chaotic situation, everybody and his brother will want to take that gold or silver off you for sure. Not today, because nobody knows what it is. But if we go to a chaotic situation, everybody will want it. So that's your first thing. But the second thing is people are saying, what if this chaotic situation which we see coming with the debt leads to, let's say, a very serious situation of hyperinflation or capital controls or rations or a bail-in where you're forced to put a certain amount of your assets into government bonds or some sort of exchange controls. There's a lot of scenarios out there, but if you have the gold, it's nobody's liability.
This is Clive's masterclass on why to own gold, silver. 1. Insurance or parachute metaphor is perfect. You don't buy parachute hoping plane crashes. You buy it before flight in case it does. By time you need it, it's too late to get. Same with gold. Buy before chaos, now, not during, when unobtainable. 2. Don't need to ask permission is key. In crisis, governments impose A. Bank withdrawal limits. Sorry, $1,000 day max. B. Capital controls, can't wire abroad. C. Bail-ins, Cyprus 2013, deposits confiscated to recapitalize banks. D. Exchange controls, can't buy foreign currency. E. Asset seizures, gold confiscation like 1933 FDR. If you hold physical gold, silver, you don't need permission. It's in your possession, not in system they control. 3. Nobody knows what it is. Today, opportunity. Most people dismiss gold as barbarous relic or doesn't yield income. So demand is low, supply available, though tightening. In chaotic situation, everybody will want it equals demand explodes, supply vanishes. By then it's too late to acquire at reasonable price. 4. The scenario list is sobering. Hyperinflation, Zimbabwe, Venezuela, Weimar, capital controls, Argentina constantly, Greece 2015, rations, Wee 2 type, possible and severe crises, bail-ins, Cyprus template now standard EU law, exchange controls, can't convert to dollars, euros. These aren't fantasy. They've happened repeatedly in history when government's desperate. 5. Nobody's liability equals critical distinction. Dollars are liability of Federal Reserve, U.S. government. Bonds are government liability. Stocks are corporate liability. Bank deposits are bank liability. Gold is asset with no corresponding liability. It exists independent of any institution. If institutions fail, gold persists. 6. For COMEX disaster, this parachute mentality means gold-silver buyers are not price-sensitive speculators who sell volatility. They're insurance buyers who hold through volatility. This supports physical demand even as paper price whipsaws, creating divergence that strains COMEX supply.
It's
Right.
yours.
The market is bracing for a massive technical shift as gold shows a powerful bounce back on the weekly charts. While paper markets remain volatile, a major supply crunch is quietly brewing behind the scenes. Global exchanges like the COMEX and Shanghai are seeing silver inventories plummet to critical levels, signaling a potential disconnect between physical metal and trading screen prices. We're also joined by Mario Ineko, who analyzes the deepening delivery squeeze on the COMEX. Mario highlights a massive gap between open interest and the actual registered silver supply in vaults, suggesting that the bullion banks may soon face a reckoning. He warns that with hundreds of millions of ounces tied up in futures contracts and a dwindling physical stockpile, the stage is set for an explosive move. Let's watch some clips from his interview.
And I wanted to show you first the chart of gold here. It's a weekly chart of gold. Yes, we had a massive run up towards the end of January. Gold got up to the high was 5,602, the spot price. And then it corrected by the beginning of February 2nd, the week of February 2nd, it corrected down to a low of 4,402. So, 1,200 point move, very volatile. And why did it happen? Well, I think it got a little bit ahead of itself, and the bullion banks took advantage of that, of course. But it's bouncing right back up, as you can see on this weekly chart, and I think it's starting to look quite bullish. I don't like making calls like this, but I wouldn't be surprised if we are near 6,000 very soon. And what do I mean by very soon? I don't know. Maybe a month or so. But I've seen that even the bullion banks now are upping their forecast for gold for this year. Silver is going to take a little longer, I think, to kind of pick up. But once it does, it's we're going to blow right through that 121 level, I think. And I think the Gnome of Zurich is going to be right about the 199 level. And I think that's coming soon. Just like gold is going to 6,000, in my opinion, very soon.
Mario's technical plus target analysis provides timeline for coming moves. 1. The 5,620 to $4,142 correction, 1,100 points equal 21% drop, got ahead of itself, plus bullion banks took advantage. Classic pattern where parabolic move gets knocked down by commercials/shorts, but then resumes if fundamentals intact. 2. Bouncing right back up on weekly chart is recovery underway already. The correction is healing, not deteriorating. Weekly chart shows big picture. Daily noise doesn't matter. 3. 6,000 very soon, maybe a month or so from late Feb recording equals March-April 2026 timeframe. That's $5,000, $6,000 equals 20% gain in 4 to 8 weeks. Aggressive but not unprecedented, given gold did 14,500 in January, 25% in weeks. Even bullion banks upping forecasts is significant. Bullion banks, JP Morgan, HSBC, etc., are usually conservative, often suppressive of gold. If they're raising targets, it means A, can't fight the trend anymore, B, positioning clients for higher prices, C, maybe covering shorts. This is capitulation signal. 5. Silver take a little longer to pick up, acknowledges silver's lag. Gold typically leads, silver follows with leverage. So gold 5K 6 kept 20%. Silver might lag initially, then catch up with 30 to 40% move. 6. Blow right through $121 is emphatic. Not test $121 or reach $121, but blow through. Implies $121 is just waypoint, not destination. If blowing through, where to? Next resistance 140.50 or straight to. $799 Gnome of Zurich was Egon von Greyertz's target. He's Swiss, Zurich-based, called Gnome affectionately. $199 from $83 current equals 2.4x equal 140% gain. This aligns with historical silver-gold ratio targets. If gold $6,000 and silver $199 equals 30:1 ratio versus current 60:1. Makes sense. 8. Coming soon repeated is Mario believes this happens in 2026, not distant future. The convergence of factors, COMEX squeeze, central bank buying, debt crisis, dollar weakness, accelerates timeline.
Well, let's quickly look at where things are this morning then. Spot gold is at $5,070. It's down $14. The high's been 5,100 and the low has been 50.44. Yeah, silver was hit hard overnight. As usual, we got down to 81.50. Right now we're at 83.80, down like 50 cents. The high's been 85. And the other thing that we need to keep an eye on, aside from price in silver, which is really more important, is the dwindling supply of silver in the major exchanges of the world, like COMEX, Shanghai Gold Exchange, Shanghai Futures Exchange. And we have a post here from Dario this morning. And it says 2,500 open interest rolled forward from March 26 to May 26 silver futures contract. That's on COMEX. Well, that means that people who are long March silver, they've rolled into May. They sold the March and bought the May. So that means they're not going to stand for delivery in March. But there's still 65,000 open interest in March, and there's still a couple of weeks to go in February before the March contract becomes deliverable. So the 65,000 open interest is 325 million ounces, and the registered supply of silver on COMEX is only 98 million. So it's going to be really interesting keeping track of this open interest and also the registered supply of silver in the vaults, because that could go down as well, because there's a lot of people taking delivery right now in February, which is not really a front month.
Ultimately, both Clive and Mario point toward a historic divergence between the paper market and physical reality. While Wall Street focuses on daily price swings and bullion bank maneuvers, the smart money is looking at the dwindling vaults and the massive premium for physical possession. Whether it's Clive's parachute analogy for gold or Mario's data on the disappearing silver registered supply, the message is clear. The safety net of physical metal is becoming harder and more expensive to acquire. As the COMEX delivery window tightens and geopolitical debt continues to mount, we are approaching a moment where having metal in hand may matter far more than the number on a screen.
Thesis. Historic divergence equals paper price saying one thing, volatile, uncertain, physical market saying another, tight, stressed, premium spiking. This always precedes major moves. When paper and physical disconnect, paper eventually capitulates to physical reality. Can't deliver, price must rise to incentivize supply or force cash settlement. 2. Wall Street focuses on daily swings. equals missing the forest for trees. Traders obsess over 83 versus $85. Is today up or down? Did I lose money? Meaningless. Smart money ignores noise, watches structure, vault levels, delivery patterns, premiums, central bank flows. 3. Dwindling vaults, massive premiums equals two sides of same coin. Supply dropping, vaults emptying, drives premiums up, scarcity price. Clive's $400 over premium is symptom of vault stress. 4. Clive's parachute analogy, insurance not speculation, plus Mario's data, 325 mem versus 98 mem numbers, equals qualitative. The philosophy, why own, and the mechanics, supply crunch, both point same direction. 5. Safety net becoming harder and more expensive equals window. Closing. Today you can still buy physical at $83 plus premium, though premium high. Tomorrow, post-COMEX disruption, maybe you can't buy at any price, shortage, or price is $150 and premium is $600, crisis pricing. 6. Having metal in hand may matter far more, liquidity versus solvency. In normal times, paper claim ETF futures is fine because liquid can sell instantly. In crisis, paper claim is counterparty risk. What if ETF can't deliver? What if futures settle cash? Physical in hand has no counterparty. You own it. 7. For viewer action, this is called a get physical now while available, even at $400 premium. Better to pay premium today than pay 10x premium or get cash settled at unfair price post-squeeze.